Joining 18 Now today is the globally fated economist Nouriel Roubini, chairman of Roubini Global Economics, the man who had correctly predicted the collapse of the U.S. housing market. Mr. Roubini, it's great to have you on the show. Thanks very much for taking out the time. Really appreciate it. Let me begin by asking you that given the history of conflict that we've seen in Europe, do you think severely indebted nations will accept Germany and France's economic diktats? Will 2012 really be the year in which the euro unravels and the union comes to an end?
Well, the economic and financial conditions of the eurozone are very severe. Germany and France cannot impose their will on all the other countries because the decisions in the eurozone are taken by consensus. The trouble with the eurozone right now is that you have severe stock imbalances, large stocks of public debt, large stocks of liabilities of the financial system, and there are flow problems. There is a recession now starting most of the eurozone. There has been the loss of competitiveness of the periphery of the eurozone. There are large external imbalances, and all the policies that the Europeans are pursuing right now, fiscal austerity and similar, are going to make that recession in the eurozone worse. So I do expect that not just Greece, but a number of other countries over the next couple of years will have to restructure their public debt and private ones in a coercive way. And I also do expect that one or more members of the eurozone eventually are going to exit the eurozone. If it's a small Greece exiting, that can be managed. If eventually it were an Italy or a Spain having to exit, that will be effectively a breakup of the eurozone. So of all the sources of systemic risk in the global economy, certainly the problems of the eurozone are the most severe.
You do not expect a complete breakdown of the European Union or even the concerns that are coming in on the status of the euro. You think those concerns are exaggerated?
No, I do believe that over time, not this year, some of the member states are going to restructure their debts in an orderly and in some cases even disorderly way, and eventually, starting with Greece, but potentially even other countries, could exit the eurozone. I don't expect a breakup of the eurozone in 2012, but I would say that if you take an horizon of the next 3 to 5 years, there is a meaningful probability that a number of the member states of the eurozone might eventually decide to exit the eurozone, and eventually a breakup of the eurozone is going to occur. The point is that, however, the crisis of the eurozone is not going to be a sudden death, but it's going to be a kind of a slow motion train wreck where initial economic difficulties, then financial, then fiscal, then debt restructuring, and then eventually exit might occur, but that's going to occur in a slow motion with separate countries having difficulties at different points in time: Greece, Ireland, Portugal, Italy, and Spain. So it's not going to be a sudden collapse.
So, Mr. Roubini, how do you view the currency situation shaping up then? The last 6 months have been months of the dollar strength. Even if this is gradual, over the next 12 months, how do you see the dollar, the US dollar, shaping up vis-a-vis the euro, and how it may be over the next 12 months, as also the other currencies?
Well, relative to the euro, I would say that given the economic and financial difficulties of the eurozone, the euro should be weakening. There is sovereign risk, there is the risk of a breakup. The European Central Bank now is easing monetary policy while the Fed for the time being is on hold. And on a fundamental basis, while Germany can live with a euro at current level because it's uber competitive, the countries in the periphery of the eurozone, if they have to have a chance to survive in the eurozone and not exit the eurozone, they have to have a much weaker value of the euro. The euro should be falling on a fundamental basis towards a parity with the US dollar to give a fighting chance for Greece, Ireland, Portugal, Italy, and Spain to survive in the eurozone. Now, I don't predict that the euro is going to fall to parity with the US dollar, but I would predict that in the next few months, as these economic and financial difficulties of the eurozone are going to become more exacerbated and the policy solutions are going to be found to be limited, that the euro is going to weaken relative to US dollar. The other point about the US dollar is that the US dollar tends to strengthen when there is periods of time of risk off and risk aversion in the global economy when there are tail risk and there are these episodes of risk aversion deriving from trouble in the Eurozone or geopolitical risk. People tend to dump emerging markets currency, they tend to dump the euro and seek the safety of the US dollar, US treasuries, not because economic and financial and fiscal conditions in the US are very good, but just because the US is the tallest midget in the room, or the least ugly in a beauty contest where the issue is not who is the prettiest or more handsome, but who is the least ugly. And therefore, when there is risk aversion, people go to the safety of the US dollar and treasuries. So since I do expect that tail risk is going to be repeating themselves in the global economy, that overall might be bullish for the US dollar. Again, not because things are great in the United States, but just because in relative terms, they're worse in other parts of the world.
I'm guessing the beauty pageant contestants, Mr. Roubini, aren't complaining though. Okay, just taking off from that answer of yours, the last couple of months, we've seen some good news on a relative basis, some good news coming out of the US. Are these green shoots, or do you believe these are one-offs which will probably taper away over the next couple of quarters?
I think that these good news are going to be temporary. Yes, some of the macro data of the U.S. has been better than expected, but I do expect economic growth in the U.S. this year is going to be anemic, subpar, below trend, at best 1.5% growth year over year, for a number of reasons. First of all, the problems of the Eurozone, and through trade and financial links, those are going to slow down economic growth in the United States. Secondly, there'll be a significant fiscal drag in the United States this year because of the gridlock in Congress. Third, since domestic demand is going to be weak in the U.S. because of private and public sector deleveraging, the way the U.S. could grow faster is by an improvement in net exports, but the trade balance of the U.S. this year is not going to improve because, one, growth is slowing down in the rest of the world in Europe. That's going to be bad for U.S. exports. Two, for the reason I discussed, the dollar is going to be stronger, not weaker, and that's going to worsen U.S. trade balance. Three, oil and energy prices are going to remain high because of geopolitical risk in the Middle East, and therefore the oil import bill for the U.S. is not going to improve. Therefore, the net exports of the U.S. are not going to improve, and that's going to be another factor. It's going to be source of economic weakness. And finally, the U.S. consumer is still very challenged, both income-wise, wealth-wise, and debt-wise. Income is not growing very much because the labor market is improving only weakly. The wealth has been sluggish because equity market has been flat and housing prices have been falling. And the U.S. consumer is still having a huge amount of debt and debt servicing. And the process of deleveraging of the U.S. consumer has been just postponed. So all these factors, in my view, suggest that economic growth is going to be remaining anemic in the United States in the next few quarters.
The other aspect, and I want to draw your attention to the European region again, is what's happening with the European banks, which are essentially shying away from lending to companies, and most of the funds loaned by the ECB are coming back as deposits to the central bank. Mr. Roubini, everybody's asking this question, how will the crisis be overcome essentially? What can the ECB do to replicate the US Fed's success in reinflating the economy?
Well, you point out rightly that because of the financial strains in the Eurozone, where sovereign and banking risk are highly interrelated with each other, because the banking risk became sovereign where the banks were bailed out, but now sovereign risk has become banking risk because a large part of the public debt is held by the banking system. Right now there is a credit crunch, and the credit crunch is becoming more severe because banks don't have enough capital, don't have enough liquidity, and they have to reduce their leverage by essentially reducing credit and disintermediating, and that's going to create more of a credit crunch. Now, the ECB is not a full lender last resort for the sovereign, but has been playing increasingly a role of lender last resort for the financial system, because without the support and the liquidity support of the ECB, the credit crunch and the deleveraging and the run on the banks will become even more severe. The problem is that the ECB is going to do more to backstop the banks and the financial system, but for a number of legal and institutional reasons, the European Central Bank is not going to become a full lender last resort for the sovereigns, and unlike the Federal Reserve that has a dual mandate, growth and inflation, and there's also a mandate on financial stability. The ECB has only one mandate, there is one of price stability, so there are legal and institutional constraints in the willingness and ability of the ECB to play a greater role. Yes, they're going to play a greater role, but I think that the fiscal, sovereign, and financial and banking strain in the Eurozone are going to remain still severe, and there's going to be only partial willingness of the ECB to address them.
But they would require very strong support coming in from France and Germany, which really haven't been able to draw consensus when it comes to resolving the crisis. The European debt sales, especially by France, have met with some considerable success. Is there a sign then that perhaps we are, even though we're taking baby steps, we are looking at seeing the European region buy time to kind of save its sovereign rating for these individual economies, France and Germany in particular, and thereby be able to kind of control the crisis by managing their own economies?
Well, as you said, there have been baby steps taken in the Eurozone, and the problem right now in the Eurozone is that there is a double-dip recession, not just in the periphery of the Eurozone, but the latest data also from some parts of the core shows that there is the beginning of a recession, rise in sovereign spreads in some parts of the core, and a banking problem even in the core of the Eurozone. And unless you restore economic growth, anything else you do in terms of fiscal austerity and reform is not going to be sufficient. And actually, austerity in the short run makes the recession worse because you're raising taxes and cutting government spending. In order to restore growth and therefore make the Eurozone viable and sustainable, you need a whole series of different policies. The ECB has to aggressively cut rates, has to do quantitative easing, credit easing. The ECB has to become a lender of last resort, not just for the bank, but for the sovereign. The value of the euro has to fall another 20 to 30%. And if the periphery of the Eurozone is going to engage in recessionary and depressionary fiscal austerity, Germany and core of the Eurozone should postpone their fiscal austerity and actually should be doing fiscal stimulus. In my view, the joint probability that Germany is going to accept aggressive monetary easing, a weaker euro, and a fiscal stimulus is very low, and therefore I worry that the recession in the Eurozone is going to get worse, and therefore the fiscal and financial problems of the Eurozone are going to get worse rather than getting better.
Mr. Roubini, I want to draw your attention to China and India in particular as well, because a lot of viewers would want to hear views on those. There are a couple of opinions that came out about how there might be a possibility of a hard landing in China, and that may trigger a bit of a cool-off in commodity prices, which eventually, after the dust settles down, would augur well for economies like India. What's your view, one, on how China will shape up in 2012, and two, the resultant impact on other emerging economies?
Well, in the case of China, for 2012, I do not expect a hard landing, but a slowdown of growth. But my view are more bearish than consensus. I do believe that Chinese growth this year is going to be, around 8%. That is much lower than it has been in the last few years. And there is a risk of a hard landing, but that hard landing may materialize only in 2013 or 14, because this year there is a delicate political transition in China. By November, they have to choose their new president and premier, and therefore China is going to do anything necessary to prevent the hard landing from occurring. The problem with China is that the growth model of China is not sustainable because it's based on net export growth, on fixed investment is now 50% of GDP, on high savings, and with a very low level of consumption right now is only 1/3 of GDP. So unless China can consume more, save less, reduce net exports and fixed investment, and make its growth more balanced, eventually China could have a hard landing, but that's a 2013-14 story. As far as India is concerned, there's been a slowdown of economic growth in the last few quarters. The economic data are mixed. This year, growth might be only 7%. That is disappointing compared to the hopes that the Indian economy could grow much faster over the long term. And India is facing a variety of issues. There is a fiscal deficit. There is a current account deficit that has to be financed. The rupee has been weakening. Inflation until recently has been rising. And more importantly, there has been a policy stalemate. a number of structural reforms have to be undertaken in order to make sure that potential growth becomes higher so that India can grow faster without causing higher inflation. But because of coalition politics, because of the fact there is a wide range of important state election coming up in the next few months, the policy has been essentially in a stalemate. An important economic and structural reform should be undertaken, have been essentially stalled, and that's not good news for accelerating economic growth over time.
In that sense, Mr. Roubini, do you think the second half of this calendar year could spell good news or perhaps renewed confidence in India if indeed we see favorable results coming in from the state elections and then a renewed push on reforms in the following budget?
I would say that economic acceleration is going to be conditional on a reacceleration of a series of important reforms having to do with dealing with the fiscal problem, dealing with opening up the economy to trade and financial flows, greater openness to foreign direct investment, privatization, flexibilizing the labor market, maybe introducing a national VAT, and a number of other things. The acceleration of this reform might be conditional on what's going to be the outcome of some of these important state elections. We'll have to wait and see whether the drive to reform is going to accelerate once part of that political cycle is behind.
Right. You spoke about the rupee and the severe fall that the currency is seeing. That pretty much has been the case with all emerging market currencies, and you alluded to the point of the dollar's strength signaling risk aversion. What would be your outlook on emerging market currencies that would, essentially dictate flows?
Well, the outlook for emerging market currency depends very much on the country. I don't think you can generalize. I would say there are some countries like China and other emerging markets that tend to have current account surpluses, and with currency overall maybe on an appreciation trend. And there are other countries like India, but also countries like Turkey, like Brazil, and a few other ones that are actually running current account deficits. And therefore, these countries running current account deficits may face further depreciation pressures unless there are enough capital inflows to finance these large current account deficits without downside risk to the currency. And those capital inflows depend on many factors. They depend on the degree of risk sentiment and risk aversion of international investors. They depend on the state of monetary policy within these individual countries, and also depend on what are the fiscal conditions. So everything else equal, if a country runs a large current account deficit that is in part driven by large fiscal deficit, if this country has an easing of monetary policy, and if global risk aversion is going to stay high because of global tail risk, there could be further downside pressures to that currency.
Mr. Roubini, so for the next 12 months or the next 18 months, what asset classes or what asset class in particular do you believe is most likely to give a beneficial return? Would it be equities of emerging market economies or the developed economies, or would it be commodities that you would bet on? What is it that you think has a fair chance of doing so?
Well, my global economic outlook is one in which, while there will be economic growth, there are significant downside risks that imply risk of a recession in the Eurozone, even UK, slow economic growth in other advanced economies like the US, and also slower economic growth compared to last year in most emerging markets. So in that climate, there's economic of vulnerability with also financial tail risk. I think that investors are going to remain risk averse, and therefore, like last year, global equities might move sideways without any clear trend. When risk is on, they might go higher, but when risk is going to be off, as likely they're going to move downwards. And therefore, I don't see a significant outperformance of global equities in this environment. In this environment, also, commodities might also move sideways because while emerging markets are growing still robustly, economic growth in most advanced economies is going to be weak, and therefore the two things are going to be a wash. Of course, commodity prices could go higher, especially for oil and energy, if geopolitical risk in the Middle East, like potential confrontation between Israel, US, and Iran, could lead to a risk premium in oil prices. So in my view, we're still in a world in which there are many tail risks, and therefore it's better to be safe rather than sorry. An investor will be better off by investing into the safe bonds of government and countries that don't have significant fiscal vulnerabilities, or in companies that have very strong balance sheet in terms of having low debt and leverage, having high dividends. So, companies that are multinational corporations, both in advanced economies and emerging markets, with sound balance sheets and sound P&Ls, probably might outperform. But we live in a world in which there will be lots of tail risk, and therefore being defensive in terms of global asset allocation and being less exposed to a variety of risky assets, whether it's commodities or equities, and being more exposed to things that are more liquid and more safe might be a strategy that minimizes some of the downside risks.
Right, Mr. Roubini, before we let you go, Mr. George Soros was in India recently, and he said that the European Union crisis is perhaps more severe than what the world was afflicted with in 2008. As you leave us, just a broad perspective, are you as pessimistic that this scenario could perhaps lead to a catastrophe, so to speak, in world markets 6 months to about 8 months down the line? What is the way out then?
Well, I would say you have to assign probability to something disorderly happening in the Eurozone, and you have to assign some probability to disorderly defaults and even a breakup of the Eurozone, not in the next 6 to 8 months, but certainly over the horizon of the next 2 or 3 years. And if, and I'm just saying if, that breakup of the Eurozone were to occur, the systemic effects of it could be much bigger than the disorderly default of Lehman Brothers in the fall of 2008, because after all, Lehman Brothers was a $600 billion problem, while the debt, the public debt of Italy and Spain alone are at 3 trillion euros, or about $4 trillion dollars, and therefore if there was a disorderly default by Italy and or Spain, that will be a shock that will be systemically more important than even the disorderly collapse of Lehman Brothers. So I'm not predicting that to happen in the next 6 to 8 months, but I would say that you have a set of countries in the Eurozone, Greece, Ireland, Portugal, Italy, and Spain, that each one of them with different probability could have a coercive restructuring of their private and public debt, and each one of them with different probability could eventually exit the Eurozone. If the combine of these events were to occur, the systemic effects on the global economy would be absolutely as severe, or actually more severe, than what happened in 2008. I'm not saying that it's going to happen with probability 1, but you have to consider that this is an important tail risk that has a meaningful probability that would have a systemic effect on the global economy over the next few years.
We live in uncertain times. Mr. Roubini, thanks very much. Enjoy your stay in India, and thanks very much for taking out the time to speak with us this morning.
Well, a pleasure being with you today. Thank you.